Hi, good morning, everyone. Thanks for joining us for today's weekly morning call. Today, we have a few stock counter updates. Those include Adobe, Block, Lipo Mall, LHN, and we have Phillip on the ground for Keppel, Pacific Oak, and China Aviation Oil, as well as the initiation of NVIDIA. And for the technical analysis, we have S&P 500, Samudera Shipping, Alibaba, and Xiaopeng. And for the macro outlook, we have the Singapore banking update, FOMC meeting highlights that was last week, and the usual SG Weekly for week 13. So as Zane has to head off for another webinar, we'll begin with Zane today. So Zane, please.
Thanks, Darren. So now I'll move on to the technical portion. So first up I'll be covering the S&P 500. So for S&P 500 in this chart, it's currently trading in this descending broadening wedge pattern over here. So we can see some sort of volatility expansion going on in this wedge. Then within the wedge itself, we are currently trading in this channel itself. So you can see we're actually tightening up to this potential resistance zone over here. That's near about the 4,000 level for the immediate resistance. And the upper bound of the resistance is likely to be at 4,100 area, which would be a potential retest of this previous uptrend support line that was being broken down. So with that, the immediate support currently could be at the 3,850 level, which is near a retest of the lows generated in early March. And there's also the 50% Fibonacci retracement level as well. Deeper retracement could bring it down to maybe 61.8% retracement. That's near 3,760 level over here. Okay. Moving on to my individual counters, the first one I have is Samudera Shipping. So for this, we have a technical sell at $1.32. Take profit can be set at $1.19. The stop loss is at $1.40. And the stop loss closed at $1.31 on Friday. So for Samudera Shipping, there's a potential retest of the $1.19 swing lows formed in February over here, as it's currently trading in a downtrend channel at the time of writing, after it broke down of an uptrend channel prior to that. Looking at the technical indicators, it's also flashing bearish divergence signals with lower highs being posted, while the stock actually made higher highs in the process. So with that, the stock could actually pull back to retest this $1.19 support level, which was the swing lows formed in February this year, as well as a previous swing high formed in August of last year. And moving on to my second stock counter would be Alibaba Group Holdings. So for this, we have a technical buy at $83.70. The take profit can be set at $92. The stop loss can be placed at $79, and the stop loss closed at $86.90 on Friday. So for this, we have a potential retest of the $92 swing high formed in February if the breakout works out. So what we observe for Alibaba is that it actually broke out of this downtrend channel over here, and that is after it retested the support level near the $82 level, which is confirmed with a 61.8% retracement level seen in the chart over here. Now, when we use a swing low of $58 and a swing high near $121. Looking at the MACD technical indicator, while the breakout took place, there was a fresh bullish crossover recorded as well, which is a bullish signal. So with that, the price will actually head higher if the bullish momentum currently continues to retest this $92 level, which was a recent swing high from just last month. Then moving on to the last stock counter will be Xpeng Inc. So for this, we have a technical buy at $9.91. The take profit can be set at $12.90. Stop loss can be placed at $8.90, and the stop loss closed at $9.62 on Friday. So for Xpeng, there's a potential retest of this $12.90 swing high, which was formed in February last year. Actually, because the stock actually broke out of this bullish descending wedge pattern over here. So that's a bullish chart pattern. With that, when we take the height of this wedge, which is around $3.40, and we project it at the breakout point over here, that brings us to the near the $12.90 mark as well, which is confirmed with the swing high resistance. So with that, the stock will actually continue its bullish momentum, and should the trade work out, it could potentially retest this resistance level in the time to come. So that's all from me for the technical analysis part today. Yeah, so I'll pass on my time to Ambrish to talk about Adobe first quarter 23 results.
Thank you, Zain. And good morning, everyone. So last week we had released Adobe's first quarter earnings report. Overall, the first quarter 2023 revenue and PATMI, they were within our expectations with 24% of our full year forecasts. In terms of its performance, its total revenue grew by about 13% year over year in constant currency to about 4.7 billion US dollars. And notably, the company, it generates consistently strong gross profit margins of about 88%. And this is mainly because of its recurring subscription revenue model. In terms of its bottom line, the company reported adjusted PATMI of 1.7 billion. And this is after excluding non-cash items like stock-based compensation expense and one-offs like acquisition-related, Figma acquisition-related expenses. So moving on to the positives, first of all, the demand for its Creative Cloud segment, it remained resilient. So Creative Cloud, it's a part of digital media business segment. So the Creative Cloud revenues, it grew by about 8% year over year to 2.8 billion. And also there was the annual recurring revenue, the Creative Cloud annual recurring revenue, it grew by 8% to 11.3 billion. And this annual recurring revenue, it basically means the revenue that Adobe expects to generate on an annual term. So in the first quarter, the net additions for the annual recurring revenue, they were about 307 million. And the growth, was mainly driven by a strong demand for its photo editing and video editing applications like Photoshop, mainly because of surge in digital content creation. Moving on to the second positive, Document Cloud strength, it continued in the first quarter, and it was the fastest growing segment with its total revenue, growing by about 13% to 634 million. And its Document Cloud annual recurring revenue, it grew by 18% to $2.4 billion. And the main growth drivers for this segment was mainly because of a strong demand for its continued momentum for its PDF capabilities and e-signature capabilities. Management also highlighted that its Acrobat PDF was now the default PDF viewer in Microsoft Edge, which has about a billion users annually. Moving on to the negatives, Adobe, it continued to face headwinds from foreign exchange rates, and its total revenue, the top line, it was impacted by about 200 million from the currency fluctuations. This is important mainly because Adobe, it generates about 40% of its revenues from international markets outside US. So moving on to the outlook for the full year 2023, the company, it raised its GAAP earnings per share forecast to $11 and also maintained its revenue guidance of 19.2 billion at the midpoint. This was despite of the ongoing macro uncertainty. So additionally, the company, it also increased its net new digital media annualized recurring revenue to $1.7 billion. And this was mainly because of its strength in its diversified product portfolio for Creative Cloud and Document Cloud. And as well as the company said that it's witnessing traction in its new initiatives like a video collaboration tool, which is Frame.io and Adobe Express. So moving on to our valuations, we slightly lower the full year revenue mainly because of slowdown in IT spending, and we lowered our PATMI by 3% due to higher expenses. So as a result, our target price, it was reduced to $402 from the previous $408. However, we downgraded the stock to accumulate mainly because the stock price has run up in the last few trading sessions. So overall, we believe for our thesis for Adobe would be that it's still the long-term beneficiary of a shift to cloud and paper to digital transformation, as well as the rising digital content creation. So that's all for Adobe. Would now like to move on to Block. So last week, Hindenburg it had issued a short report on Block. So we would take a look at some of the key points from the report. Hindenburg, it's basically a US-based investment firm, and it's known for its short reports for Adani, as well as a short report on Nikola in 2020. So for Block, its report, it was mainly focused on the Cash App business, as it generates about revenue. Cash App, it's basically a consumer-facing business, and it mainly provides banking solutions to the users, as well as the users, they can invest in stocks and Bitcoin. So the first allegation was that the Cash App business is slowing down. So if we look at the charts on the right-hand side, the Cash App inflows, as well as its monthly transacting active users, they are now growing at a slower pace as compared to FY20 as well as FY21. And the significant growth in FY20 was mainly because the company, it promoted that the unemployment benefits during the COVID times, which the government had provided. So the users, they can get those immediately, and there was no bank account required to receive them. So that's why there was a significant surge in inflows as well as number of users. So that has been slowing right now. And also the company, it believes that its instant deposit feature, it's a magic technology. However, the Hindenburg, it believes that it's just a standard offering, and also it's expensive as compared to its peers like Venmo and Stripe. So moving on to the second point, Hindenburg, it believes that the Block, it has inflated its user metrics and claims that about 40 to 75% of the Cash App accounts, they are either fake or they are duplicate, which are associated to a single user. And as a result, it's a misleading key performance indicator, and the company, it should provide the how many a unique number of users they have. And so Cash App, moving on to third point, Cash App, it's mainly provide solutions to either unbanked or underbanked population. And Hindenburg, it pointed out that this Block, it mainly benefited from this demographics, and which facilitated fraud. So like there was no, it claims that there is no proper KYC norms, and which, I mean, as a result, various fraud accounts were created, which were, I mean, used for thefts or scams, and also for illegal activities. Despite of these issues, they were reported by the users or by employees. What Block was used to do is, it used to blacklist those accounts and not the user. So it was easy for the user to return to the platform. So, and the fourth point, it peer-to-peer losses. The Block, it reported these fraud losses under the sales and marketing expenses, mainly to mask those losses and avoid public relations issues. And moving on to the fifth point, Hindenburg, it pointed out that Block, it mainly relied on non-GAAP adjustments to showcase that it's profitable. So like in FY22, it converted its net loss of $540 million to an adjusted profit of $613 million. And mainly because after adjusting out the 1 billion stock-based compensation expense. And lastly, the response of Block, Block, it has denied its allegations, and it plans to take the legal action against Hindenburg. So overall, to conclude, I feel that the Cash App business, which is slowing down, and the reliance on non-GAAP adjustments, these are the two valid points. And however, these are already known to investors. And also, the worrying point could be the inflated user metrics, as This is the main growth driver for its Cash App business. So that's all for block. I would now like to pass on to Max for NVIDIA.
Thanks, Ambrish, and good morning, everyone. We recently published a initiation report on NVIDIA with the title AI is the Future. So just as a brief background, NVIDIA is a semiconductor company that designs and sells graphics processing units and or GPUs that were originally used for consumer PC graphics for rendering graphics for consumer PCs. But recently, its GPUs are found to be useful in data centers usage as well, such as for AI as well as autonomous vehicles. Next slide. Yeah, so in terms of the revenue model, NVIDIA reports mainly in two segments, which are graphics and computer networking, with each of them making up consisting of different revenues from different end market usage of the GPUs. So for FY23, we just would like to note that the financial year ends on January of each year. So FY23 has actually ended in January. So for FY23, data center was the largest business, making up 56% of the revenue, and this was closely followed by gaming. Making up 34%. So during last year, data center actually overtook gaming as the major revenue contributor, which was historically gaming was the main business for NVIDIA. Last year, NVIDIA recorded a revenue of $26.9 billion, which was flat year on year. And this is because gaming actually experienced a decline of 27%, but this was offset by the increase in data center of around 41%. So despite this, we expect the revenue to grow at a 2-year CAGR of 15%, driven by data center strength, and the gaming revenue to recover because of the channel inventory issues that have been solved. So for FY23, they recorded a net profit of about $4.4 billion, which is quite a significant decline from $9.7 billion from FY22. But this is mainly because of the two one-off costs, which is the $2 billion inventory charge, as well as a $1.3 billion acquisition termination charge that the company incurred during the year. And furthermore, the R&D expenses also increased by 39%, which historically is normal because NVIDIA has constantly increased the R&D expenses for any given year. So if we strip out the effects of the two one-off charges, the adjusted PATMI would have been $7.9 billion for FY23. Next slide. In terms of the investment highlights, we have identified three. Firstly is that NVIDIA is the market leader in the discrete GPU market, as the company holds an 88% share for consumer PC, as well as 91% share for the data center discrete graphics processors market. The market leadership comes from the fact that NVIDIA's products has a superior performance, and this is evidenced by the fact that NVIDIA GPUs powers about 72% of the total and 90% of the new systems on the 2022's World Top 500 supercomputers list. And furthermore, this programming language called CUDA, which was developed by NVIDIA, was the first language to allow developers to program to code directly onto the GPU. And this CUDA is actually widely adopted by developers worldwide. And furthermore, this language runs solely on NVIDIA's GPUs, which means that the developers are locked into the platform, and this can act as a strong mode for the company. Secondly, is that NVIDIA data centers business is exposed to the strong growth momentum. So the data center revenue quintupled or grew by 5 times within 3 years, from $3 billion in FY20 to $15 billion in FY23. And we expect this growth trajectory to continue, especially during the recent trends whereby there's increasing demand for AI in data center as companies across industries would like to integrate this technology into their operations. And furthermore, there's also an estimate that the AI-centric spending is expected to grow at a 4-year CAGR of 27% to surpass $300 billion by 2026. And furthermore, towards the end of last year, the versatility as well as the capability of generative AI, which essentially is ChatGPT, has spurred interest in enterprises to develop and deploy the technology. So we think that this should also provide a tailwind for NVIDIA because it coincides with the launch of its next generation data center GPU, which is designed to handle these type of large language models like ChatGPT, which is the most complex AI model right now. Next slide. Yeah, so for the third investment highlight is that NVIDIA has been able to record stable and attractive margins. So NVIDIA has been able to maintain the gross margin of around 60%, and it has been increasing from 59% in FY17 to the high level of 65% in FY2022, while net margins were relatively stable at the 30% range. So the gross margin and net margins took a dip for FY23, and this was mainly because of the inventory charges as well as the acquisition charges that I mentioned just now. So if we strip out the effect, the adjusted gross margin would have been 65%, which is in line with what they achieved in FY22, while net margins will come in at 29%, which is roughly in line with what they experienced throughout the past couple of years. So we think that this stable margins indicates that NVIDIA is able to pass the increased cost to its customers. And we view this as a favorable trade because this means that any growth in revenue should also cause an increase in their earnings. And furthermore, NVIDIA has also guided for a gross margin of 66.5% for the first quarter of fiscal year 2024, which is a slight increase, which is an increase from the 63.3% that they achieved in the fourth quarter of last year. Next slide. Yeah. However, in terms of the risk we have identified two, firstly is that the company's reliance on TSMC. So NVIDIA is a fabless company which means that they don't produce their own chips and they outsource their production to companies which is like TSMC. So we think that the product investment on NVIDIA is going to be heavily dependent on TSMC to constantly improve and sustain their competitive advantage. And because of the supply concentration risk, we think that NVIDIA may be adversely affected should TSMC face operating challenges in the future, or that it loses competitive advantage. Secondly, is the US-China tension. So NVIDIA is quite heavily exposed to the Chinese market because China makes up about 20% of its FY22 total revenue. And therefore, we think that if the geopolitical tension between the two countries escalates, it's going to cause significant uncertainty in terms of NVIDIA's ability to maintain their business in China, because especially if the US decides to post additional curbs and limits the NVIDIA's capability to sell the products to their customers. Next slide. So finally, moving on to our valuation, we initiate coverage on NVIDIA with a buy rating at a target price of $315 based on the DCF valuation. And this is based on a WACC assumption of 6.8% and terminal growth rate of 4.5%. That's all for me for NVIDIA. Now I'd like to pass on my time to Glenn to talk about banking update.
Yeah, hi everyone. Yeah, so for the banking update, it's just a very quick comparison with Singapore banks and the Credit Suisse banks bonds. So I think there's also a question in the Q&A who asked this specific question, but what's the difference between CoCo bonds and perpetual bonds? So anyway, I'll just quickly go through the background of what happened with Credit Suisse. So basically, their bonds were their AT1 bonds or additional tier 1 bonds were written down to zero as part of a forced rescue merger with UBS. And this is surprising because the holders of their AT1 bonds were actually ranked below shareholders or equity holders who usually get paid who usually get paid when a bank or company collapses, and the shareholders received a total sum of US $3.23 billion. And so, anyway, just a brief sort of what AT1 bonds are. They are actually known as they're usually known as contingent convertibles, or in short, CoCo bonds. So what's the difference between CoCo bonds and perpetual? So CoCos are debt securities that can be converted into equity sometimes, and if certain predetermined triggers are met. So an example of what these triggers are such as the bank's capital ratio falling below a certain level. And on the other hand, perpetuals are, on the other hand, a type of debt security that do not have a specific maturity date, and they also do not have any conversion features. So if you look at Credit Suisse, for example, but the interesting thing about Credit Suisse, if you look at it, is that all of their AT1 bonds or CoCo bonds actually do contain sort of in the fine print that it makes it clear that in such an event of collapse, they would mean a complete and permanent write down to zero, and that there will be no partial or temporary write downs if it were possible, basically. But if you look at other banks' AT1 bonds, they actually do include partial or temporary write down features. But and also Credit Suisse bonds, AT1s, did not have any conversion features. So majority of other banks, they actually do have conversion features for their AT1 bonds, and it can be converted into common equity in a stress situation. And also, sorry, one more difference which I missed out was that these CoCo bonds or contingent convertibles are usually placed in the additional tier 1, while perpetuals are usually in the tier 2 capital. So anyway, just a quick comparison with Singapore banks, namely DBS, OCBC, and UOB. Firstly, the first comparison, you look at the table on top there. Singapore banks do not have as much AT1, and also the bonds are non-convertible for Singapore AT1s. And I think the main worry we have for at least for in Singapore is that whether or not it will happen, the same thing will happen if, let's say in the worst case scenario, happen to Singaporeans or Singapore bondholders. But MAS has released a statement on 22nd March stating that, quote, equity holders will absorb losses before holders of additional tier 1 and tier 2 capital instruments, quote. So what this means is that the same thing that happened to Credit Suisse will actually not happen to the holders of the Singapore banks bonds. So this will mean that the shareholders will not be paid out before both AT1 and tier 2 bondholders. Yeah, so I hope I made that clear, and I hope I also answered the question in the Q&A. So that's all I have. I'll now hand it over to Darren. Thanks.
Thanks, Glenn. Yeah, so we hosted Keppel Pacific Oak US REIT last week. So these are some highlights of what happened. Core is US office REIT. There's a market cap of $430 million. Its portfolio occupancy is at 92.6%, which is this is slightly higher than the peers of the other two US listed REITs. And the DPU is down 8.5% year on year, but if you adjust it, because they paid in 2022, they paid second quarter and to the fourth quarter, they paid all their management fees in cash. So if you adjust, you strip that out, the DPU will be down 1% year on year to 5.80 US cents. So on the capital management front, there are 78% of their borrowings are hedged to fixed rates, and their all-in interest rate is 3.2% with a leverage of 38.2% and an ICR of comfortable ICR of 4 times. So they are still for FY22 they have 3.8% positive rental reversion, and they are expecting the rental reversions to remain around these levels going forward in FY23 because of the quality of their assets and the location of their assets. However, they did mention that there are a lot of relocations out of California. As you can see, the graph. So the graph on the top right-hand side, that is the California headquarters, the losses, like the number of companies that are moving out from California. As you can see, is increasing from 2018 all the way to 2021. 2022 numbers, however, are not updated there, but it's pretty high as well. And at the bottom right is the where they relocated to. So you can see that number one is a lot of them relocated to Texas, and Texas is where a lot of Keppel Pacific Oaks US REITs assets are. Like they have a couple of assets in Houston, Texas, and Austin, Texas. So the reasons for the relocations are because there's a high cost of buildings, and there's a housing affordability crisis that's causing a shrinking population in California. And a lot of them, where they relocate to is, like I mentioned, is to the red states, which is the Republican states, where they have lower taxes and better regulations there, as well as lower home prices and lower cost of living. So the physical occupancy at Keppel Pacific Oaks properties are at 60%, while the US average is at 50%, and the gateway, the assets in gateway cities, the physical occupancy is only at 40%. Core, however, they expect this their physical occupancy of their portfolio to increase because a lot of companies are mandating at least a 3-day work week back to office. And for the outlook, Core is avoiding the gateway cities as there are a lot of issues there, especially the crime rates. The crime rates in the gateway cities, especially LA, is much higher than the red states. And Core right now is trading at a dividend yield of 14.5%. Yeah, so that's all for me for Core. I'll now hand over the time to Sean.
Yeah, thanks, Darren. I'll be going through the meeting highlights that happened on the 22nd of March, last Wednesday. Yep. So last week, the Federal Reserve has raised the federal fund rate by 25 basis points to a range of 4.75 to 5%. This is in line with market expectation, despite a handful of investors who are hoping for a pause in this meeting. So in terms of guidance, we should be experiencing one more 25 basis point hike, bringing the rate to the projected level of 5.1% before the rate starts to hover till the end of this year. And although prior to the meeting last week, market have been pricing in potential rate cuts, at the later part of the year. But these sentiments were dampened by Chairman Powell, as he has stated in the meeting that rate cuts happening this year was not in his base case. So if you were to look on the chart on the left, you're able to see the dot plot graph that was provided in this meeting. And in 2023, 10 officials are expecting rates to be around the range of 5.1%, while the rest are expecting it to be higher than 5.1, and only one to be below 5. So, I mean, this further cements the view on the potential rate cuts happening this year will be highly unlikely. And lastly, although the discussion of a pause in hikes was considered in light of what happened in the banking sector, the recent inflationary data such as the PCE and CPI index still remains elevated, showing that inflations are still persistent. So the members have voted unanimously for a quarter point hike in this meeting in view to tame inflation. So, I mean, all in all, it appears that we are just one more hike away to reach the peak of the hike cycle. However, all these are still variable as the Feds could decide to push the rates even further if inflations are still not showing signs of slowing down. But I mean, after the recent turmoil in the banking sector, the central bank will definitely be treading cautiously, because if they are too hawkish, it may potentially trigger another round of fragility in the economy. But premature relaxation could also unravel the efforts that they have put in place earlier. So moving on to the next slide. Now I'll be sharing on Lippo Small Perpetual Bonds, which will be callable this year. So Lippo Mall currently has 2 perpetual bonds on the market, which is 6.47 and 8.09 perpetuals. These 2 bonds are non-cumulative, which means that the issuer have no obligations to repay any outstanding coupon payments, and the bonds are currently trading at distress levels. So why are these 2 bonds trading at distress level? It's because in Lippo's latest earnings, the firm has announced that the REITs are intending to cease distributions for these perpetual bonds for cash conservation purposes. And on March 20th, this has materialized as Lippo have released the announcement that the distribution for its 6.47 perps will not be paid. So the malls that Lippo owns are also showing signs of recovery struggles as occupancy rates and shopper traffics both remain below pre-pandemic levels. And also Lippo Mall financials are reported in Sing dollars, and their loans are borrowed in either USD or SGD. So Lippo Mall may also face currency risk if Indonesian rupiahs were to further depreciate, as their earnings are denominated in Indonesian rupiahs. Credit rating agencies such as Moody's and Fitch have also downgraded its REITs bonds recently from B to C category, which stands for the bonds are in distress and have a high likelihood of default. And with the leverage ratio of 44.5% and a cash balance of 111 million in their latest earning updates, the 142 million worth of debt that will be maturing in 2023 this year will be quite an uphill task for Lippo to refinance. Therefore, I think at this juncture, it is not wise to be holding on to any Lippo's perpetual, as these bonds are non-cumulative, like I've mentioned earlier, and the red flags are starting to appear in the financials. So on the next slide, this is a chart to show the credit ratings of the ratings agencies, and Lippo perpetuals are currently close to the bottom within the junk bonds category. So on the next slide, this is just a quick snapshot on what are some of the REITs, Singapore REITs perpetual that will be callable in 2023. And with that, I would like to hand over the time to Paul to share on LHN. Thank you.
Yeah, thanks, Sean. So we had a visit to LHN's Collivu property in Orchard. So we're just going to give an update. Next slide. So for LHN, we visited their new property, co-living property called Collivu on Orchard. It's a 411 keys. So we think this project alone will raise their capacity by 40%, which mathematically means you'll raise it to 1,400 units. So what's so different about co-living is that it serves it's like a medium-term resident. It serves the medium-term residential lease market. So what we mean is that if a tenant wants to stay very short-term, then you could stay in the hotel. But it's shorter than a rented apartment. Most apartments you need to stay, 1 or 2 years. Whereas this one is in between, and it's also more affordable than the service apartment in terms of the price per unit. So what we have seen is that since launch, the take-up rate has been encouraging, in part also because the rental market is so tight, and also the very good location is near Orchard MRT, and the rental that they're enjoying is probably going to be more than 3,000. I think some of their properties probably have a wait list too, because right now the rental market is so tight. As reflected, last year, the residential market was up almost 30% in 2022. In terms of the types of tenants they have, like 2/3 or more is foreigners. The 20% locals are maybe some millennials that can afford and also want to stay closer to home and maybe away from their parents. Anyway, then there are also some locals that are maybe shifting homes and they will stay in the co-living. And of course, there are also students that come over to stay. Just to distinguish how they kind of maximize the space. So they actually took over from Fraser's residence service apartments that had 72 units. So what they did was they converted it. They didn't demolish the whole building. They converted all the units inside, and then they made it into 135 units with 411 keys. So what we mean is that maybe one unit, you actually can have three rooms inside. Of course, it sounds like very narrow, but what actually happens is that as you walk in, there are virtually like 3 separate rooms across with 3 separate keys. Each will be fully fitted. I mean, it's in move-in condition. So one of the attractions for co-living is that it's moving condition. Rather than if you rent an apartment, you still have to get your utilities done. And the deposit is also higher if you rent an apartment. Whereas for this, we show you photos later. There's a kitchenette. Everyone has attached bathroom, TV, everything, and there's housekeeping once every week. There's no change in our forecast or no change in our target price, but this is a significant property because the Collivu Orchard alone, I mean, you just take 3,000 times 411 with a bit of occupancy adjustment, you can get almost like 15 million revenue, which was the whole of what they got last year. And now they probably hit 1,004. They probably target near term 1,006, and the pipeline is for another in total another 2,500 keys. So they can actually almost double the number of keys they have from the current levels. Our target price not changed, is about 6 times PE and also dividend yield of 6%. Next slide. And the book value is 45 cents. Yeah. Next slide. Okay, so this picture just of course on your top left is how it looks on the outside. Then they have outdoor areas like a typical apartment. Every room has a queen size bed. At the bottom there's also a pool. Of course, it's not an Olympic size pool. Yeah. And of course, every unit has you can cook, you can wash. There's TV there. There's everything. It's fully fitted in a move-in condition, and every room has a attached bathroom. And of course, the other distinguishing thing, probably not here, is that they also hold a lot of events for the tenants. So that's where the co-living aspect comes in. There's a lot of events to get the tenants together and so forth. So that's another thing that they emphasize on. And next slide. So I'll just run back to our usual weekly. In terms of the macro, not much in Singapore, but the industrial production numbers came out. So industrial production is just like manufacturing activity. So that is probably, we are still in the 5th month of contraction. So although February is down 16%, but February Chinese New Year, so all the numbers have to take it a pinch of salt. But if you take the year to date, that means January and February, you combine, it is still down 6%. We also had some of our inflation numbers, which is still, I think, still above the MAS target. I think MAS target first half is 5%. We are like 5.5. So in the April meeting, I mean, it's not clear. Maybe they might tighten a little bit more. I mean, it's not very, because the global growth is slowing down at the same time. But what it does suggest is that inflation is higher than their target of 3.5 to 4.5 on average. That means throughout the year. Of course, the power, like Sean mentioned, some of the comments. I think for me, the main takeaway was two things. Firstly, they did mention tighter credit conditions. That means what we think is going to happen, which we'll elaborate later. But they also, in their formal statement, they did change a bit of the wording from ongoing rate increase. That means it's like indefinitely they were going to keep on raising. They thought it was appropriate to now they expect some policy, some firming. They didn't even mention the rate increase. That means additional policy firming. So in a way, this statement could say that they are already kind of like almost like a pausing stage, because policy firming is more like they'll still do QT but not rate increase. Otherwise, they'll mention rate increase. May be appropriate, and the word is also may. So I mean, not to make this into an English lesson, but it does suggest that they are softening their stance in terms of interest rate increase. So in our tactical view, we think a pause is very likely. Because whichever path they take, we think interest rates have peaked. What we mean is that either economy slow down, inflation slow down, regardless, I think the interest rates have peaked and would come off, if not by this year, by latest of next year. So one of the main things that will probably happen, especially in the US banks and even the European banks, is that, I mean, if you're a bank CEO, with what's happening now, of course, you also want to save your job. You probably want to just conserve your balance sheet. I mean, that's probably the any bank CEO will want to do that. So they'll probably cut lending, or maybe not refinance, or not, or whatever they call it, they won't lend out. So they will cut lending because, number one, the banks will be concerned about growth, especially with what's happening. And you just worry there's a vicious spiral, because if the bank thinks other banks are also tightening, then that means the borrower will be affected. Then it might become like a vicious cycle. I mean, this is speculation, but this is a concern. And also, of course, with depositors so nervous, even attacking Deutsche Bank, I'm not sure why, but Deutsche Bank earnings doubled, but they want to be liquid. So the only way to be liquid is not to lend so much. So this, we think, will be the additional way the monetary conditions will tighten. Not only just interest rates, but the banks won't lend. Of course, this is only 50%. I mean, the other 50% is the securities market, which we haven't double checked, but we should think also that the credit spreads will widen, which means that the credit markets are also tightening. That means the securities, bonds and all that. So for us, our strategy is like, virtually, buy anything that like crack like a bond, or even look like a bond. So which eventually leads us to REITs. Even gold could rally, but because gold usually has a hedging aspect to it, so we think even TLT, like we mentioned last week, which is the ultra long 20, this is the most aggressive way to play interest rate coming down, which is the ETF, and most of their bonds are more than 20 years. So this is extremely sensitive and a high risk way to play dropping interest rates. So in terms of some of the events, you probably get some fat comment by Jefferson. He's a FOMC member, but the key one will be on the 31st of March, which is the core PCE. So this is another, I don't know why this is the Fed's favorite indicator of inflation. Let's make it CPI just to make things easier. But anyway, this is another inflation indicator that they'll look. We got a lot of events from our research side. So we have today, we will have a REIT fireside chat where we will have two CEOs. We will have a chat with two CEOs, two REIT CEOs, sorry, and Darren will also do a presentation. So do sign up if you have time today. And we have also two US companies. One is Wuzik. So if you want to know more about AR, VR technology, what's the latest, you can dial in for that. Another one is Materialize, which is more into 3D painting. Yeah, sorry, this is a bit of a promo here, sorry. But then Saturday we have our Singapore strategy. Another interesting one, again, sorry, this is the last one, but will be our Turkey and Thailand research team. So why we think it's interesting is because for Turkey, you know, Turkey has one of the worst inflation rates, but actually their equity market is very strong. So I guess if you want to learn more about what asset classes perform in a very high inflationary environment, then maybe you might want to dial in and listen in. I mean, I myself want to listen in, but there'll be something, you know, if you're interested, you know, do sign up for that too. Okay, yeah. Sorry, this is the last one for promo. Next slide. Okay, so China Aviation also has had an analyst briefing. So let me just run through a little bit. So for those who are not familiar, so China Aviation there are two parts to the business. One is all trading. So all trading is as basic as that. They can take orders here and then buy and sell here. So of course those are very low margin. I'll explain a bit later on. Then the other part where probably earn 3/4 of the profits in a normal year is they have a 33% stake, associate stake in Shanghai Pudong Airport refueling jet fuel company. So just think of it like a petrol kiosk in Shanghai Pudong Airport. So any plane that want to fly off from Shanghai Pudong International Airport, that's probably the only fuel station that you can pump your jet fuel. So sorry, can you go back? Yeah. So in terms of the earnings decline mainly because, you know, China shut down. There's hardly any flights flying off. And Pudong even then still contributed 50% of profit. They are still a net cash company. Okay, so of course the story here is that the upside when China reopens. So just to give you a sense, right now the associate earnings is about probably about 20. Sorry, you can see from here is about 20 plus million US. But during the good years, it rose as much as 70 to I think close to 80 million in profit. So the ability for earnings to double or triple is possible. I mean, if the visitors return to normal. And of course, that is one part of the business. The other part that we mentioned, jet fuel trading. So that is a bit harder to determine the margins because it depends on the opportunities for them. So there are two ways where the trading business usually makes better margins than not like picking up the phone and taking orders and like no, I want to buy and then sell. No, those like order taking business. So one is when there's a contango. So what it means is that when they because they have their own storage. Sorry, it's a bit complicated, but if it's a contango, that means the forward. That means the oil price near term and forward is rising. That means the future months the oil price is higher than current, so they can actually store the oil in their storage facilities and then earn the spread. The other thing was last year they made money because of the Ukraine dislocation. So there was, I think, excess oil and shortage of oil in certain geographies. I didn't slip my mind which countries. So they managed to kind of like take shipments from those that were cheaper geographically and send it over to Europe and so forth. So these were some of the things that they would, otherwise the profitability is quite limited because, you know, you're just doing order taking, like how much your customer going to pay you for them. Yeah. Oh, okay. I think that that's it for now. I think we can move into the Q&A. And we apologize because Zane has a 12 o'clock event. So sorry, he won't be able to take any of the technical Q&A. So apologize if you have any, because he has a 12 o'clock. He's actually doing a 12 o'clock presentation right now. So any of the Q&A. Yeah, I think we can move on to the rest. Yeah, thanks. Yeah, Ambrish, you want to take on some? Or Max? Yeah.
Sure, Paul. So there was one question with respect to Adobe. Can you give some light on the acquisition of Figma, and are they overpaying for Figma, and what will be the forward impact? As well as in continuation, another question was, who are the competitors for Adobe? For Figma acquisition, Adobe, it's acquiring Figma for almost like 20 billion US dollars. So in terms of this valuation, so Figma, it generated annual recurring revenue of about 400 million. So this is as much as 50 times it's overpaying, 50 times valuation it's paying, Adobe is paying for Figma. And in terms of its forward impact, management has highlighted that after the deal is closed for the next 2 years, its margins could be down by about 1 or 2 percentage points. And the acquisition would be accretive to the bottom line earnings per share only by the end of year 3. So for in terms of another question, Adobe's competitors, Adobe, it mainly competes with DocuSign in its document cloud segment. And as far as I think, DocuSign, it's still not generating any earnings. It's still not profitable on the bottom line. And for its content cloud segment, it competes with CorelDRAW, Canva, there are several competitors, as well as Getty Images, which competes with Adobe Stock. So there was another question with respect to Block. Acquisition of fraud by Hindenburg is serious, but by maintaining an accumulate rating on Block, are you taking the stand that the acquisition is likely to be unfounded, or likely to have no impact on its future, even if it turns out to be true? So I believe right now, I would like to wait for the company's response to the allegations, mainly because it might not be possible to go and validate its fraud comments, fraud allegations. So maybe after that, when we issue our second quarter earnings update report, we would change estimates based on that. And have the allegations against Adani died down of late? What are the key differences with Block? I will just try my best over here, and maybe Paul can just later on add. So for this, for Adani, as far as I think, Hindenburg, it mainly said that its debt levels are high, and also the management used to do a stock price manipulation, as well as there were accounting malpractices that were followed. Whereas for Block, the main concerns that were highlighted, as I mentioned, that it was mainly because that there was a slowdown in its in its cash app inflows, as well as the user metrics, the number of users. The company reported inflated users. The management, the Hindenburg claims that the management is aware of that. However, it's still not reported, disclosed this in its reports. So yeah, that's all for this. Maybe Paul can add in later. Thank you.
Yeah, sorry, Ambrish, I'm not. I guess the main difference is probably the huge leverage. And I didn't go through in details for the Block, but I think in general for us, it's going to, when it comes to fraud, I think like we mentioned before, it's virtually impossible for us. I mean, if the auditor signs off on the accounts, I mean, for us to come and say there's fraud, we can only, like Ambrish mentioned, if there's aggressive accounting, yes, I think that part we can only mention. But if it's fraud, that's the thing. That's why we hesitate, because we really can't. Almost impossible for us to determine. Yeah.
Yeah, I'll take some questions on NVIDIA. I think there's two. First is that what proportion of NVIDIA's Chinese business in the last year is now limited by the new US trade regulations? So the NVIDIA only issues that the warning about the trade regulations for the Q3 last year, where they say that potentially about 400 million of their sales to China is going to be affected if the customers decide not to cancel their purchases. But following that, NVIDIA actually released a modified version of the product. So after that, they never say anything about the impact as any also. So I guess majority of the Chinese customers were willing to accept the modified products instead. But yeah, although NVIDIA did never really give us the exact figure of the prices of their data center GPUs. From what I saw is that the modified product, which is the A800 and replace the A100, is only slightly cheaper than the A100. So yeah, I guess there's potentially some of the revenue impact, but NVIDIA haven't really disclosed the figures as to how much it was affected by the trade restrictions. Then the next question is, given the high interest rates, how was NVIDIA WACC determined? So yeah, so for our WACC, we assume a cost of equity of about 8%, and the cost of debt based on NVIDIA statements is about 3%. And then one more thing to note is that NVIDIA has quite a high proportion of debt for the capital structure at about 30%. And this is way higher than the 2% of that of Meta and Alphabet. And because of this alone, the WACC is already low. It should be lower than those of the tech peers. And furthermore, there's also the market expectations that the risk-free rate is going to come down, as the Fed is expected to cut down the rates in the medium term as well. So yeah, that's how we derive at our NVIDIA's WACC. Thanks.
Oh, thanks, Max. I'll take on one. I think two questions. First one would be asking, the recent bank problems, is it the beginning of a recession? I think it'll be very hard to say, because just the banking problems, firstly, we look at what is happening recently is mainly due to the fall in bond prices, which caused a bank run, at least for SVB. And that's the main one that actually, the first fall of the domino, I guess, and then everything else cascaded. And if you look at Credit Suisse, it's also years of problems which they have been having. They've been loss-making for the last 2 years, so 2021, 2022. So actually, those problems were already there to begin with, and it just escalated because of what happened with what happened in the US. So I wouldn't think necessarily that it is the beginning of a recession. There are a lot of other factors that we have to look at, such as unemployment and consumer spending, which both actually still do not indicate that this is the beginning of a recession. So I think the main thing we will see is that this sort of, for Credit Suisse, will be problems which they already had going into whatever happened, the crash now. And for SVB, it would be sort of putting all the eggs into one basket and just buying a lot of long-term securities, and that eventually caused their downfall as well. Okay, I think I have one more question. I think it's a TA, but maybe I will just talk about the fundamentals since Zain isn't here. So the question is asking, is it too late to buy DBS and UOB? So asking to comment on technicals. So anyway, I'll just comment on the fundamentals a bit. DBS and UOB, yes. So DBS and UOB is quite similar in terms of the outlook. Firstly, we're going to FY23. We do expect that their net interest income and as well as the net interest margins will continue to rise with the high interest rate environment. So this will continue to improve at least into the first 2 quarters. That's what we expect of FY23, and then it will sort of peter off into the second half of the year. But if you look at a full year basis, their NIMs will definitely still be higher compared to FY22. So this will improve their net interest income. And the second one, which we see, we will expect a very big improvement, would be the fee income, because they're coming from a very low base in FY22. I think it's almost across the banks is about a 16% decline from FY21. So FY21 to FY22 is about a 16% decline in fee income. So we do expect that this will sort of jump up by at least 10% a double-digit fee income growth. So this will also boost their bottom line when going to FY23. Yeah, so I think I've answered the questions. Yeah, I'll hand it over to the rest of my colleagues. Thanks.
Yeah, thanks, Glenn. I'll answer some questions. There are actually quite a few questions, but all of them are just asking the same thing, which is the Manulife, Prime or Keppel, Pacific Oak. Okay, so I'll just start with Manulife. So Manulife, there was some news report that came out that they were going the manager Manulife was going to be acquired by Mirror Asset Management, but actually the Manulife actually came out and said that this is not finalized and they're still in discussions. So right now is people are just guessing or hoping that they might come in to save Manulife, or so there's actually not much details on that yet. But the outcome of their restructuring will likely to have some quite some material details in the second or rather first quarter this year, which means the next results briefing. So they are likely to come to give some material information then. Yeah, so you only can wait until then, because now a lot of it is just a news which is not true per se. Yeah, so that is for Manulife, the general thing. So yeah, let me just read the details. Okay, so please rank the 3 US REITs, Prime, Manulife, Keppel, Oak for the dividend yield growth target price. Yeah, so all 3 of them, I believe, are trading at above 15% dividend yield. And for the 3 REITs, we only cover Prime. So we don't have a target price for the other 2. But the one of the 3, which is Manulife, is the one that is really struggling compared to the other 2. A lot of it because of the asset locations also. Manulife has some properties in LA, which is a Figura. We saw the huge decrease in valuations. And as Prime, as Core said during the webinar, LA is one of the markets that they want to avoid, the gateway cities, and a lot of the shrinking population, and a lot of people are moving out from there. So a lot of companies are moving out. So that is not a good sign as well. Okay. Yeah. So the decline in price for all 3 is basically in line because a lot of news in the market that's saying, oh, the US office is so bad, and then and there's some default in like the Columbia Property Trust and the Brookfield. But then those 2 assets also, those 2 asset managers, they defaulted on the loan because of it was a secured debt that is on assets that is in LA. Yeah, so because of that, they also raised funds, and they also raised funds on floating rate. So when the interest rate shot up, then they started paying interest that is more than their rental income that they can receive. So which is why they couldn't pay and they defaulted. I think that is some of the reasons why it's trading so cheap as well. And basically it's market sentiment. That's why all 3 is just crashed basically. And yeah, another reason we think probably Prime is so-called the share price is dropping because of probably one of the top 10 tenants is likely going to vacate also. Yeah, so yeah, a couple of reasons. Yeah, and which one is worth taking the risk now to invest in view of the big discount? Yeah, actually, if you look at it, near term, then it is very risky. But over the long run, we think Prime, because Manulife, there's still some issue with the manager. I mean, there's not issue with the manager. It's just that they are doing some restructuring, so it's a bit risky to invest in them. But for Keppel, Pacific Oak, and Prime, I believe in the long run, it's still worth to invest in them because they're trading so cheap and at a very high dividend yield. The Manulife probably have to wait to see how the restructuring, the outcome of the restructuring before you take any investment decision. Okay. Manulife United Hampshire fell sharply today. Any comments? Yeah. I don't know why it fell today. I don't know why. I don't see any news in the market. Yeah, so the news of possible myriad investment in Mars. Yeah, just to add on that, the possible investment of the myriad investments, last week Manulife issued an SGX announcement that the discussion is of myriad investments is actually to acquire additional shares. I think that they might issue new shares to myriad investments rather than acquiring from the open market. But this it's just an announcement. It's not say hard fix. Yes, they're still in discussion basically. Sorry, let me see. Are there any new? Okay, I think that answered that. Any developments? Your view on S-REITs like CapitaLand or Mapletree related ones? Do you see the price us already pricing in, including next rate hike in May too? Yeah. So for this, as a whole, we are now actually overweight on REITs as a portfolio in comparison to a lot of other subsectors. On a portfolio basis, we are overweight, but then we of course we acknowledge the fact that it's still quite challenging for REITs because of the rising interest rates. I mean, it's probably going to peak soon, but this high interest rate is going to affect when they refinance their loans in the next couple of years. Because last year's their interest rate, like the start of the year, was still very low. So if you take a look at the average interest rate for the year, it's still pretty low, but it will start to shoot up as they refinance going forward in the next couple of years. So that will definitely affect our DPU. It will be challenging for a lot of the REITs. So if you want to pick a REIT, I would say, the CapitaLands or the Mapletrees are the bigger players and the kind of the safer ones with a stronger sponsor. If you're a lower risk investor, I would recommend you invest in these bigger cap REITs that are maybe index included with a strong sponsor rather than those smaller cap REITs that are way more volatile in the share price as well. My view on data center REITs, good time to buy now. Oh, I didn't see the share price. So maybe Paul could answer take some questions. So I'll get back to you on this question after Paul answers some questions. I'll get back to you on that. Thanks.
Sean, can you take the difference, the PERPs and the AT1s?
Yeah, sure. So as to bring up the questions on what's the difference between PERPs and AT1, which I think Glenn has slightly mentioned earlier. So although AT1 bonds are also perpetual bonds, but these bonds are only issued by banks and are designed to meet capital requirements. So for AT1 bonds, or also known as COCO bonds, are considered to be high yielding and a riskier type of perpetuals, as they usually comes with loss absorption features such as the convertible clauses, where bonds can be converted into equities of the issuer, and it also sometimes comes with a write down clause. So if the issuer's capital falls below a certain threshold, which usually sometimes it comes with CET1 ratio triggers. So whereas for Lipo Mall, it is just a normal perpetual bonds that does not come with any convertible or write-down features. But however, I think distributions for REITs perpetual securities are non-cumulative and they do not accrue. So I mean, investors will lose these distributions if the issuers does not choose to pay up. It also usually comes with a dividend stopper, which it's in this case for Lipo Mall. So if if the issuer decides not to pay up the distributions to the perpetual holders, the company shall not pay dividends in respect of its junior securities as well. So because perpetuals are one up or above equities in terms of capital structures. Yeah. So I mean, this is the main difference between the AT1s and perpetuals in this case. So I hope this further clarifies on these questions. Thank you.
Yeah, let me just add. So the one major difference, the perps and the AT1s, is that in the AT1s, the tier 1 capital, there's a hand grenade or nuclear bomb inside the AT1, whatever you want to call it. So just to dial back, why are these called tier 1 capital? They're considered tier 1 because they are permanent, not just like equity. Permanent means don't have to pay back, just like equity, right? So for the banks, they consider tier 1 the best type of capital because it's permanent. So why there's a hand grenade or nuclear bomb inside these AT1s is because there are mechanical triggers. That means there can be some triggers where if your capital is below certain ratio, you either you lose half your value or you lose everything. So that's where the hand grenade is. But the other trigger is a non-viability trigger, and this is decided by the authorities. So the authorities can say, oh, you are going to bankruptcy, or for Credit Suisse case, what happened was that they believe that you are going to bankruptcy, and this is considered to them a trigger to make you zero, to trigger this hand grenade. So as a result of that, they go to zero. So that's one of the difference. Even the perpetuals for the banks, Singapore banks, also has this particular feature. But like what Glenn said, the MAS still considers them above shareholder equity. So that is one of the that's one of the main difference that I think everyone needs to be aware of the difference between perps between perps and perpetuals. Just that for Credit Suisse, the authorities consider this as they call it what's the point of non-viability. So it's a bit contentious, and that means they're considered Credit Suisse non-viable. So that's why I can trigger this clause to kind of self-destruct the whole cocoa bonds. But yeah, anyway, sorry, it's a bit complicated here. But okay. Okay, let's move on to some questions. Hi, what will be the key catalyst to bring LHN share price up? I think that the two growth drivers for them will be firstly this Collie Wu because this will be the big earnings growth driver for them, because rental market's so hot, so this can drive earnings. That's number one. Number two would be, I think the other question was their LHN Logistics, which is also listed, which is the new ISO depot. Okay, I think most people won't I also didn't really understand what was the ISO depot. Sorry. So what they do is that LHN Logistics, they have this style of trucks that will go into Jurong Island Chemical, and then they will fill up these trucks and then bring the chemicals out, transport the chemicals to PSA for export. So of course, very regulated, very controlled, and because LHN and you know, because Singapore regulations, they probably have to, I don't know, wash the tanks with a toothbrush or something along those lines. But it has to be very tightly controlled because they're flammable, and you know, you might be driving through residential area. So LHN, the second catalyst for them is that they are setting up a depot to clean, to store, and also to repair this. So it's a huge facility in, I think, 7 Gul, and also it will generate additional new revenue for LHN Logistics and also for LHN. But this will only happen in June. It will only open in June of this year. So because LHN's financial year is June, right? So the only impact will be on June FY24. So these are the two main catalysts, Collie Wu and also the ISO tank facilities. Yeah. LHN also has parking spaces and commercial. What is this revenue? The revenue is smaller, so I don't have it offhand. But parking is smaller, so they actually also have a few hundred or parking space. Sorry, it slipped my mind the total amount, but they also own parking not only in Singapore but also in Hong Kong. And one of the things they're doing for parking is also to install EV refilling. I'm sorry, EV for EV cars to charge, EV chargers. Sorry, it's still my mind. Yeah. So that's the other thing they're also doing for the parking, and they managed to buy most of this parking. When during the pandemic, when there was hardly any parking because of the lockdown. So that should also be a positive for them, because there's a rebound in, of course, activity everywhere. Your view on LHN Logistics, which so I think this year the earnings will be won't be that strong, but the other thing for LHN Logistics is they also own a container depot. Again, a container depot is just a parking lot, a parking. Think of it like instead of car park, is a car park lot for containers to go and store. That did very well because when the ports had a lot of congestion, right? So the ports had a lot of containers stuck in the port. So that was a strong earnings for them. But of course now because right now export is coming down and so forth. So that shouldn't be as strong as in the past. Okay, for LH, for LHN, is it mostly students for college? Oh no, mainly foreigners. 70% is foreigners. Students are 10%. What are the where are the students coming from? Actually, I'm not very sure where the students. And I think they don't, they also don't care. They just look, as long as they pay them in Sing dollar, I think they'll accept any students from anywhere. So I didn't really ask. I mean, it's a good question, but I didn't ask where the students. They could be, I guess, from China and ASEAN countries, but I guess most important, the student pay the bill. So I don't, so I didn't really ask that, but I'll ask them next time when I see them. Yeah, thanks for that. What is the current occupancy rate overall? I think it's basically full. Of course, Orchard is not full because it's just open, but my guess Orchard is probably now 70% since launch. But they're opening. I think they open. There's still a few more units to open, but it's going. I mean, the demand is insatiable because there's a lack of units, right? A lack of rental units available. I think not just co-living. I think in general, you can see the rental market is very tight even now. It should soften a bit because there's I think 20 or 30,000 TOPs, if I'm not mistaken, this year. But nevertheless, the demand is still strong. It may not be like that robust, but it's still healthy enough for them, because they fit in a category between it's a category between a short-term and long-term stays. Oh, is your target price unchanged because the 40% increase? Yeah. My target was unchanged because we kind of factored that into into our forecast. Yeah. China has reopened. Which sector in Hong Kong market will pick up? Yeah, sorry, we don't really cover Hong Kong, so yeah, that's why we hesitate to comment on, because we probably give you the wrong answer anyway. So that's why for Hong Kong and China, it's better to ask our Hong Kong desk. Yeah, sorry for that. Our Hong Kong research team. Yeah. With LHN valuations very low, will they consider share buybacks? Yeah. The problem with share buybacks is that it doesn't address the liquidity issues for them. Yeah. But I think they might later on, because right now they are on an expansion. So because they are growing the number of Hollywood keys so aggressively, and they have LHN Logistics setting up a new depot. So maybe right now they won't consider that, because they are most of the funding is going to go into building the capacity. So I think that might happen maybe the following financial year, because right now all the funds is tied up into expanding the co-living and also the depot. Any idea why the Singapore market, day to day your guess is as good as why the Singapore market is up strongly today? I didn't really see anything specific. Again, it's usually just follow the US. I didn't notice anything. Maybe other attendees may have a better idea why anything particular today. But yeah, how significant? It could be maybe 10% maybe or more. I don't have the exact numbers offhand, but we did do an estimate. I don't have, but it will be a significant to the top line, the new ISO tank. Why do foreigners want to live in such a small? Yeah, it's because everything in Singapore is small anyway, right? Okay, this one is smaller, okay. But also because it is easy to tenant, you got flexibility. Oh, sorry, the question is why do foreigners want to live in such a small room? Yeah, they want to live because it's nearer to town. You want to stay so near in town, I don't think you can even get 3,000. I'm not sure. Nearer to town, fully fitted. So when you come in, internet, everything is already all done up for you, and you also get housekeeping. You get a lot of convenience. Okay. There's also community, but you know that's subjective. I know maybe some people just want to stay in a room, so that's probably me. But I'm not sure about the community part. But at the very least, they normally the location is the key, and convenience. You know, you can move in. Everything is there. Yeah. But that's an interesting question. Yeah. Okay. I'm not sure. The rest are all REITs. Are not. What do you mean by cumulative? Sean, can you maybe help the?
Yeah. So what does it mean by cumulative when it comes to bond? This means that in the event if there's any missed coupon payments that are accumulated, this must be paid out to bondholders before any future dividends or interest payment can be made for bonds that comes with cumulative features. However, in this case, for LiPo's perpetual or REITs perpetual bonds in general, they are non-cumulative. So the coupons for these perpetual bonds will not be accrued and paid out in the next coupon payment if issuers decided not to pay in the previous interest payment period. Yeah.
Yeah, I think cumulative normally for dividends, but I think these perpetual securities, basically what it means is I don't have to pay you. I mean, I don't know, it's just a legal term to tell you if I owe you long time before I don't have to pay you again. Yeah, because it usually refers to dividends, but I think that's in a nutshell what it means. Can update Silver Lake if you have any views. Yeah, I think we are still positive on Silver Lake. I think maybe Glenn can give more. And because their Mobius product is gaining traction, so just be on the lookout for more Mobius contracts. I think, yeah, Glenn.
Yeah, I think Paul has essentially put it in a nutshell, but just to maybe add a bit more. Yeah, their Mobius is the thing that is differentiating Silver Lake from the others. So just a quick recap on what Mobius is. Mobius actually is a cloud banking software. So it's very different from what we are seeing today, which is more physical based. And it allows banks to actually roll out their new digital products in a more sort of a targeted and timely manner. And they're also able to actually use their existing core banking software and sort of put this Mobius on top and work on the base, which is the core banking software they have. So they don't need to change their whole banking software just to incorporate this Mobius banking platform. So this Mobius, what are the potential users for it, for potential clients for Silver Lake, is that they allows new digital products, mainly in all sorts of segments in the bank, actually across all segments in the bank. And they also, what does cloud-based mean for clients is that it avoids the need for the banks to purchase and manage hardware assets. Yeah, another thing also that I think that is sort of a positive for Silver Lake would be their recurring revenue. And this is mainly coming from their maintenance and enhancement revenue. So with a lot of their customers really currently having either the core banking system or different types of core banking systems, which Mobius is running, which Silver Lake is running. Silver Lake is the only one that can actually sort of update the software for them. So I think one of the good examples would be during the pandemic. They had to have implement new software like to adjust the system, so to sort of whatever the MAS was saying, they had to put it in, and they had to call Silver Lake back to ask them to update their software. So this actually goes into their maintenance and enhancements revenue. I think that someone asked, any Singapore banks using their Mobius platform? Not necessarily Mobius, but they are using their core banking software. So 2 out of the 3 banks are actually using their core banking systems, which is Silver Lake Integrated Banking System, or in short, Banking Solutions, sorry, SIPS. Yeah, so actually 2 of the 3 local banks are using it. Okay, maybe I'll hand it back to Darren. I think there's some brief questions.
Yeah, thanks, Glenn. So, my view on data center REIT. Yeah, so data center REITs basically is just a secular growth where, especially in the US, the supply is quite thin, especially since the moratorium just finished. So, good time to buy now. The data center REITs are trading at about 5 to 9%, which is lower than some of the other overseas REITs. Yeah, so good time to buy. Yeah, that is. Yeah, you have to be careful lah, because it's not all rosy. Okay, seems Digital REIT also has a data centers assets in US. Please comment on the fundamentals. Yeah, so for Digital Core, right, their fundamentals are okay. Their leverage is at 34%. 75% of their debt is fixed. But then the problem with, I mean, not say problem lah. It's just that they are very small REIT where any big sell downs will really affect the share price. So I think recently there was a bit of sell down which really affected the share price. As with a lot of smaller REITs, they are also similarly affected. The main issue with the US REITs is the office space. For data centers, not so much. So the bad news is all related to the US office, especially in the gateway side, like the LA gateway city side, like downtown LA. So yeah, so not so bad. Did you call? Yeah, I think that's all for me.
Yeah, okay, thanks. Let me just move on. Please comment on the electronics sectors, namely AEM, UMS, value, and venture. Okay, let me just give you a broad stroke what's happening right now. Almost all the Singapore electronic companies are guiding for weaker growth in 2023 because of because this comes from their customer forward orders. So you should expect the next 1-2 quarters or 3 quarters the earnings will definitely be weak. So that's number one. Number two, the question is, of course, how much has been priced in. That part is very challenging to answer because most of these stocks are already down maybe 20-30% from the peak. But the thing is, I'm not sure is that when all the weaker results come out, how much will the share price come off? But having said that, in the medium term, so in the semicon cycle, the downturn right now is roughly around the 6 months, usually 12 months. So by maybe third quarter, you're more or less reaching the end of this year. But definitely for these 3 names or 4 names, definitely do prepare for growth because what is happening is that they all have got new customers. So when the cycle comes back in, they might emerge even stronger than before. Number one, because they either have new customers or they and also number 2 is because the existing customers are giving them more projects because most of the supply chain, I mean, everybody more or less know, most of the supply chain now is coming to Southeast Asia. Applied, as you all know, has set up a new facility in Singapore. Lam Research has already started scrambling for new suppliers in or second source or new source or whatsoever in Singapore. So even guys like Grand Venture, they never entered into front end, but now they're also getting to start to do articles and start to do so. So just a sign that in terms of semiconductor equipment or Southeast Asia, Malaysia, Singapore is definitely going to rally. I'm not sure what's the right word, but we're definitely rally harder than before because their customers are giving them more projects here than before because of what's happening in China. The only electronics company which I heard the orders didn't come off was actually Aztec. That's the only one because their customer is the largest online e-commerce and they probably have a new project. So that's the only one that didn't had a weaker guidance, but mostly all guide because the customer cutting orders. because of mainly the macro weakness and because they lost China, memory is weak, the usual reasons. Okay, let's just take on the last question. What is your view on property giving peaking rates, government? Which is our top pick? I think for us, the top pick is still city development. I think one news to watch is the Tembusu. I think city development launched Tembusu. That will be to watch. So the general view is that property price will still climb, but won't be as good as last year. Mainly because, like we highlighted before, last year there were 4,000 new launches. So this year there's going to be at least 11 to 12,000 new launches. So price can still climb up, but don't expect the take-up rate to like 70-80% in one weekend. That one is almost certainly not going to happen. It's probably going to be 30-40%, which is already a very good number. So we think the earnings will still be, they will still do well, but not as good as next year. So why we like CDL? Because they got a lot of inventory. Inventory is still tight now, just that a lot of launches today. Inventory is still tight. It's below the 3-year inventory, usually 3 years. Now it's probably 1.5 years. And CDL has like about 2,000 units to launch. And CDL will also benefit from the rebound in hospitality, as they have hotels in Europe and so forth. We're not sure why, but actually one of the worst index performers is actually CDL for this year, but I'm not particularly sure why. I'm not sure, maybe they're a bit nervous of their UK exposure or Europe exposure. I'm not particularly sure, but CDL is our top pick. Yeah. Thanks. And of course, we're interested picking, even when interest rates were rising, the general view, rational or not rational, is that because the interest rates will only, this is what the agents tell me, is that the interest rates will only hit 3 years' time, right, when the TOP. So most buyers doesn't seem to be too worried. Again, this is arguable. Rational or not rational. And of course, all the banks already do their TDSR at 4.5 now, if I'm not mistaken, or 4%. So all the bankers already do the TDSR. So whatever you see now are, I guess, in a way, genuine buyers to a certain extent, although sub-sales has risen recently. Yeah, there's one more question there. I'm not sure you want to take on before we end it.
Yeah, Premier Street is going down. Why? Yeah, I'm not sure why, because I also don't see any news, but I guess it's just a sell down from a couple of weeks back, where there's some news that one of the big tenant is vacating. Yeah, fundamentally, I believe they're still okay. Occupancy around 90%, flat. Their interest rate hedged out to 2024, 2026. Yeah, so fundamentally, I believe in the long run it's still okay. It's just that it would be a very aggressive call to say call a buy now. Yeah, because so much, the sentiment is just so bad. Like there's every other week there is news that the US office sector is some trouble there. Yeah, so I guess it's sentiment related. As it's also probably why the other REITs are also, the other US office REITs are also going down. Is your favorite sector in REIT still hospitality? Yeah, it still is, because we still believe in the continuing of hospitality. Yeah, so like, cause the increase in RevPAR can directly contribute to the top line of all these hospitality REITs, instead of all the other REITs where you only can kind of reprice it when the leases expire. Yeah, I kindly rank your preference in sectors. I would say hospitality first. Local industrial is also quite strong. Yeah, so that would be second. Yeah, and then retail and office. Your view on potential recession will affect the REIT in US. The potential recession will definitely affect the REITs in US, as well as the REITs anywhere. So the sell down will come eventually if there is a recession, as with the broader market. So yeah, definitely all the whole equity market will be affected if there's a recession. Yeah, I think that's all the questions there are. If there's any other questions, if not, we'll end the session today, or if anyone else has anything else to say.
Yeah, I think yeah, we just like to. I think we can end it now. I think thanks everyone for your time. Apologies we couldn't take on some of these technical Q&As because Sean is actually having a session right now. So apologies for that. I guess if you want to know more about the REITs conditions, I think you can dial in later. I think 7 p.m. we have our webinar, fireside chat. With land lease and Far East hospitality. So if you want to know what's happening in retail in Singapore and of course hospitality in Singapore too, you know, if you have the time, I mean, do dial in for that later today at 7 p.m. So with that, I'd like to thank everyone for your time and especially thank everyone for your questions. Thank you and take care, everybody.